Hello everyone, very pleased to welcome you all for this panel dedicated to real assets. So it will be, it is available to everyone online and to you in the room. Thanks very much for being there. We have a quality panel today. I will let everyone introduce themselves. I will start with a brief introduction of myself. So I'm heading the real assets financing at Natixis, and you all know that we have a strong focus on distribution, so private debt is key to us. That's why we are very pleased to have this forum and to explore all together the impacts of inflation, interest rates, digitalization, all the new paradigms that we see currently in the real assets market. So yeah, let's start with an introduction of the panelists, if you want to introduce yourselves.
So from right to left, as per the new parliament. Antoine Trush, so I'm the Chief Investment Officer of Banque des Territoires. Banque des Territoires is a body of Caisse des Dépôts, gathering many financing tools for the French territories. So in short, we advise local territories. We also finance through equity and debt products. Our equity portfolio encompasses most of the real assets of Caisse des Dépôts in the French territories. So it goes from infrastructure to real estate, especially in geographies where the market doesn't go naturally. So small cities, countryside, but also the big cities. We also have in the portfolio a lot of digital activities and energy transition activities, and we believe there is a strong connection between all these classes of assets. So that's the equity portfolio. We also have a very large debt portfolio, but a specific debt, as most French people in this panel would know, since we manage the savings of French people, the livret A. And we have a global balance sheet of more than 400 billion that we can reinvest in French economy. So that's it for Banque des Territoires. I'm very pleased to be with you this morning.
Marion Kelsin, good morning everyone. I'm Chief Investment Officer at Ardian Infrastructure. Ardian Infrastructure is one of the biggest European, and also global now, investor in infrastructure on the equity side. So we manage more than $20 billion of equity investments in Europe and in the US, in Americas, essentially, and across three verticals, which are transportation, energy, and telecom.
Hello, I am Patrick Rouvillois. I am heading the Natixis Tech Hub, which is a newly formed organization to adapt and develop our business with players who are in new tech. So either companies who are large corporates using technology to transform themselves, startups, scale-ups, or big tech, funds, and other players in the area.
Good morning, everyone. I'm Raphael Bro. I'm the European CIO for AW, which is the real estate investment management arm of Natixis Investment Managers. So we manage around 85 billion of real estate across the globe, both in equities and debt.
Hello, everyone. I'm René Cassis. I'm heading the real and private assets platform of La Banque Postale Asset Management. We are managing private debt funds on behalf of institutional investors, investing across Europe in three sectors: infrastructure, real estate, and corporates. And over the year, we have been raising and investing a little bit more than 6 billion euros.
Thank you all. And as you can see, we have representatives of equity in addition to representatives of debt, which is, in my view, important because the equity will react first to these changes of paradigms. And so it's important for debt investors to have that in mind, to anticipate the changes that could occur on the debt side. It's true that we have had already a number of changes, and that has started with the energy transition, which has led us all to change massively the way we think about topics and the way we invest. this has been already widely debated. The new topics that are upcoming are inflation and interest rates, which will have massive impacts. It's not so tangible yet, so that's what we will discuss with these quality experts who will give you their views on how they see the impact that inflation and interest rates should have. But digital transition is also a key change of paradigm, because we can see now that even for real estate companies, for example, holdco portfolio companies, there is a real challenge in the way data is collected and analyzed, and that can make a big difference in the way the assets are optimized. So that's also very important to have this view on the debt side. It is not yet a game changer from the debt side. It is already starting to be on the equity side, but it may become a game changer as well on the debt side. So yeah, just a few reminders on inflation. It should be close to 7% in Europe in 2022 and above 7% in the US, while it has been below 2% for many years. So the impacts of these are still at the very beginning and still to be assessed, and that's what we will try to do. Same for the rise of interest rates. They have increased by already 150 bips by the start of the year for the 10-year swaps. And they should reach in the US 2.75% at the end of the year, which is a huge level as compared to all we've seen recently. And in addition to that, liquidity should be much scarcer given the end of the quantitative easings, both in the US and in Europe. So liquidity will be scarcer, and that's another change of paradigm that we need to reflect on and to make sure that we don't miss the next steps. So maybe we can start with general comments on inflation and interest rates. I don't know, Antoine, if you want to start on what this inspires you.
Well, thank you, Bénédicte. Well, I've been 4 years at Caisse des Dépôts, and actually it's the first time in these past months that we feel things are difficult. Sorry to say it very bluntly, but things were quite easy. Even when in March 2020, after the pandemic started, there was a huge shock for the economy with the stop of many activities. Well, the decision from most governments to inject so much money into the economy, to guarantee, to cover fixed costs, made it easy for equity investors to continue to do their job. And I've experienced that because at Caisse des Dépôts, we were managing the recovery plan, the plan de relance of the French economy. We were pouring roughly 25 billion of equity into the French economy. You remember it was a 100 billion euro plan from the French government. But mostly when it refers to real estate and infrastructure, it was coming from Banque des Territoires. And when we started implementing those plans, I'll give you an example, tourism infrastructure, tourism real estate. Before the pandemic, the level of investment was 15 billion euro of project. Then it slowed down to 9 billion. And us, we financed roughly 2 billion of projects in 2020 and 2 billion in 2021. So we are playing a massive role into helping the sector. And it was the same for telecom infrastructure, for energy transition, and so on. And so 2 years ago, honestly, I didn't feel any slowdown. I felt like any of us that some sectors were stopped for a period of time, but then they restarted because the economic parameters were easy. No inflation, the banks were following, debt was following, and so for equity investors, the world was easy. And a little music started to play at the end of last year, and now it's playing very loud. What do we see, especially on real estate projects? I'm talking about real estate because I feel the movement are harsher, are more violent than for infrastructure. Real estate, we finance roughly in equity 300 projects per year in France, in all territories. And we felt that first banks commercial banks were starting to go away from some sectors. Once again, tourism was the first sector where some banks, and I see you, René, acknowledging that, because we have lots of discussion with La Banque Postale about that, but also with the rest of the commercial banks. And so the banks started to go away, and I think this movement is going to continue to accelerate. Well, where will the rise of interest rates stop? I don't know, and my co-panelists may talk about it. What I know is that at Caisse des Dépôts, we have decided, in terms of equity, not to follow the movement. That's the role of Caisse des Dépôts, is to be counter-cyclical. We feel the cycle is changing, so we have decided, and it was this morning that we redecided on our investment strategy, not to change our IRR expectations, despite the increased level of risk, and not to change for the moment, I would say at least for the next 6-12 months, our class allocation, our asset allocation, and our asset strategy. So that's because we play a public role, and when the tide is going, we have to stay in order to support French economy. So things were easy 2 years ago. Things are going to be difficult from now on.
Thank you, Antoine. So that's the clear view on the general equity side. René, on the debt side, what are your general views?
Yeah, I mean, just to echo and you know, without diving into the discussion about inflation and interest rate, just to echo Antoine's comment and your own comment. Yes, it's a change of paradigm. I would say it's even a change of era, right? And I definitely believe that we are living a defining moment for the real asset market, be it on the equity or on the debt side. And also I agree that this is the most significant one since probably the financial crisis. You know, we have seen ups and downs in the meanwhile, but nothing as significant. A change of area. I think a lot has been said about it. The era of almost free and abundant liquidity is over. The era of costless leverage is over as well. The era where you could generate value just on the back of decreasing interest rates, and then claiming that you're very hands-on and very smart. So this is over. So now we're back to basics. Yes, we are seeing investors reconsidering their allocation strategies. We've heard Wim this earlier on talk about it. We hear many, if not all, of our investors rethinking their broad allocation strategy, liquid versus illiquid, debt versus credit. Am I going to take more risks, less risks? What do I think of the prospect of recession? So I would say that it's going to be tougher before it gets better, right? In the short run, we are going to see a slowdown, both on the supply and demand, as people will be waiting for the dust to settle down and to understand what are the new rules of the game, what is this new paradigm about, what is the new gospel of real assets. And then I'm sure we'll talk about it. I think in the long run, this will be, you know, somehow good news for the real asset market, because it will somehow clear the market. We are likely to see in the long run less exuberance, to take a famous word 10 years ago, more sustainable leverage, maybe sounder valuation. And I think the growth engines of this market, and I'm sure again we'll talk about it, energy transition, digital transitions, are here to stay. And we're just at the beginning of that, and this will, sustain the pipeline of opportunities that we'll see on this market.
Indeed, and as it was mentioned this morning by Patrick Artus, this will hopefully enable to limit the negative impacts of inflation. And I would say that real assets should be considered as safe values as compared to the rest of the world, which means that liquidity for real assets may still be there in the future. But let's dig into that. Maybe let's start with real estate. Raphael, how do you view, more specifically for real estate, the impact in particular of interest rates? Because the one difference that we can see between real estate and infrastructure is that the impact of interest rates is much quicker in the real estate world than in the infrastructure world.
Yeah, most likely. Well, I would say probably two phenomenon based on rising interest rates. The first thing is that obviously investors would consider what is their risk premium while investing in real estate versus risk-free rates. So obviously when interest rates rise, typically investors tend to expect some yield widening on their investment, especially on their equity investments, but typically with some time delay. So between 12 and 18 months. What we can also observe is that typically the correlation between risk-free rates and real estate yields when there are significant movements is not perfect. The magnitude is I would say around 0.4%, 0.35 to 0.4%. So i.e. when interest rates rise by 100 basis points, real estate caps or yields would increase by 40, roughly. So having said that, the other aspect beyond the risk premium is obviously the leverage impact on real estate that interest rate may have. So clearly, as we can tell from now, when risk-free rates, 10-year swap or even 7-year swaps are in the magnitude of 220 to 50 basis points, depending on the countries. When you add to that 100 to 150 basis points loan margins, basically, if you are to buy a prime real estate asset at 3.5 or 4% yield, or even lower than that, if we think back end of 2021, well, basically, there is no longer any leverage effect, or leverage effect is not accretive, but mostly dilutive. So that would probably, take some investors out of the market, leverage buyers, and that would also severely impact assets where typically you would seek financing against, so typically value-add or opportunistic assets. And in turn, the impact is that while during this, ever lower interest rate environment, people have basically experienced conversions of real estate yields across asset classes and across risk profile. We are already seeing a widening of this yield, scope, and basically what we would call well, I'm not sure in English, but basically a new hierarchy between real estate yields or caps. So that's probably again the main impact in real terms. What does that mean? It means that most investors consider that the market will reprice. So we are in a repricing or a pricing discovery mode, again, as was mentioned this morning. And that means that some investors, not to say the major part of the investors, are in a kind of wait-and-see approach, as René said, waiting for the dust to settle down and see where they should invest. So the impact is that we'll probably experience a decently sharp investment volume decline this year. That doesn't mean that real estate is no longer a flavor of the day, because as you said, it provides protection against inflation. It's a kind of, safe haven asset class somehow, so that should attract investors. But for a certain period of time, there will be this wait-and-see approach, and we'll see, concretely speaking, we are already experiencing a significant amount of deals which are basically pulled out of the market. Last week I was discussing with one of the large, European real estate brokers. They had 23 deals cooking in Europe, 15 were pulled out. So that gives a sense of, the potential impact. On our side, to try and give you some concrete examples, we were on the sell side selling a pretty large asset, over 200 million in Italy, a logistics asset, industrial asset, let on a very long-term basis to a very well-known distribution company, a US one, and basically price expectations were around 350-ish in terms of yield. That was what we got in the first round bid. Then the first round winner came back in a second round 3 weeks later with a 4% yield. And literally less than a week after that, they came back and said, well, actually, we are willing to keep on due diligencing the assets, but we'll be only able to give you a price the day before the closing when we know the financing costs. So that gives you a sense of how the market is repricing. And on our side, when we're on the buy side, we are also chipping in 30, 50, 70 basis points. And in some occasions, we get away with those repricing. So there will be some repricing, obviously hiding some differences between asset classes and risk profiles.
Many thanks, very interesting. And on the infrastructure side, Marion, it looks like there is a general view that inflation counterweights the impacts of interest rates. Happy to hear you on that.
Yeah, absolutely. I share very much what you just said, and I think to a great extent it's applicable to infrastructure as well. Then there are, I think, a few points which are very specific to the asset class. One is the fact that there are some regulated assets in the infrastructure space. So for some assets, your remuneration increases when interest rates increase. So this is an additional protection that you have compared to other asset classes. The second aspect is that infrastructure assets are very much correlated to inflation. I think in our portfolio we made the calculation and it's 85% of the portfolio which is correlated to inflation, while the correlation to interest rate is lower by construction because, of course, we hedge portfolios over the long term and you have long-term debt, long-term hedging. And also, I mean, it's only a part of your assets you finance with that. So all in all, in an environment where inflation is high and interest rates are high, I would say that the infrastructure valuations still benefit from this environment. Then the question is, are the central bank's policies going to be effective, or are they going to trigger a recession? And so then you go to how much dependent your portfolio is to GDP. Because the risk you run is to have a situation in which there's a recession, and so the drop in valuation can come from slowdown, but also prospects that are more negative over the long term. I would say that when you build core infrastructure portfolios, I'm not saying that the future will be bright, but you have a dependency on GDP which is lower because you have telecom assets, you have energy assets which are less sensitive to GDP than, for example, transportation assets. So overall, in a situation where you have high inflation, low GDP, high interest rates, all in for infrastructure assets, the valuations should not go down too much. As to the volumes of transactions, I think that one specificity of this market is that there are huge needs in terms of energy transition and telecom. I think, well, it's known by everyone, but the transactions in the energy space represent more than 50% of the deal flow today. And so these needs are not going to go away. One additional point, I guess, is yes, there will be, with latency, a bit of a wait-and-see approach. But there will also be, unfortunately, players which will be caught between high capex, supply chain constraints which increase the cost of their operations, and high cost of debt, which means that there will be probably distressed players in the market which will fuel the volume of transactions.
Thank you, René. Any reaction to that?
Yeah, just to complement some of the views given by Marion and Raphael, and maybe starting with real estate. I completely agree with Raphael. Of course, it depends. The ability to pass on inflation, of course, depends on the sub-asset class. Right? I think in theory, everybody agrees that residential is a place where you should be able to pass on the inflation to the end users, because there is a mismatch between supply and demand. But then you have to deal with affordability considerations, with regulation, with, let's say, social and political considerations, and to some extent it does contradict with the responsible investor agenda, right? Probably the office space, if we believe in a mild slowdown, if not a recession scenario, so the ability of corporates to accept higher rentals is going to be limited. And then there is also the impact of home working, flex, and so on. Of course, retail, we're back to the situation of the sanitary crisis, whether it's essential needs or non-essential needs. On the tourism industry, and Antoine, you're certainly more knowledgeable than me. Just my own experience. For those of us who are trying to book their summer holidays, I think the ability of this industry to take on board inflation is just phenomenal. So I'm not too worried about.
I was yesterday at the board of Atout France, which is the body for tourism. Prices in tourism have increased by 30% in the last 2 years, and things don't go to the sky. So the industry is very aware they cannot pass on those prices increase. If I may also react on infrastructure, depends if you talk about greenfield or brownfield. Yeah. At Caisse des Dépôts, we are mainly on greenfield, on building greenfield infrastructure, and clearly we don't know, even being a public entity, whereby what we see in cost of inflation in cost of construction and inflation of cost of debt can be passed through regulated assets. Many of us have been in this field for 15, 20 years, and they have seen the shift into regulatory, whereby the regulation is not as solid as it used to be 20 years ago for infrastructure. So there is clearly some innovation to put there, and also what we do to counterbalance this new equation is that we work with constructors because also they know that they have a cyclical market, and they know that they can accept for the moment to squeeze their margins a little bit, and we can discuss on a case-by-case basis on risk sharing for that cost of construction. And also one thing which is important, and I hope that debt investors will follow, is that temporarily some equity investors accept a lesser leverage and accept some bridge financing in order to help the project come to life. That's what we see. And I will not also supplement on what Marion said. The needs for energy transition are huge. I regret being also on a public entity that the government or the governments do not state that probably in a country like France for the next 10 years there are 500 billion euro to invest into infrastructure, energy transition, telecom, and so on. I made the exercise, and with my teams we did that, to add the different needs in the different sectors. If I take just fiber, THD, sorry, fiber to home or fiber to the office, it was a 30 billion plan. If I take switching the grid for electrical vehicles, the government does not state it, but it's probably a 30 to 40 billion investment in France, and be it in the private or public sector. So if I add up, if I go just on Enedis, distribution of electricity, they need probably between 50 and 100 billion of investment in the next 10 years, and so on and so on. So my regret is, or my proposition, is that in the coming month, private and public investors will gather into understanding what this financing plan needs, and we give visibility to the corporates, to the companies, because they are the one who needs the most, actually, with also the PGE to reimburse. Now they see this squeeze that we talked about this morning, and they need visibility. So I think that's our responsibility to give visibility.
And these figures that you gave are just for France, but we can see as well at the European level that the new Renew EU Power Plan has been released by the European Central Bank, by the European Commission, and it means doubling the yearly investments in energy transition in the next few years, as compared to an investment rate which is already very high. As you said, it's more than 50% of our investments today, so there will still be a doubling of the needs. And on the digital side, we can see that the size of the projects have multiplied by 10 sometimes, on many occasions, because of the need to invest into fiber, but also into towers, into data centers. And there were many projects starting 2-3 years ago with a size of 300 million that are now 3 billion, 4 billion projects. So it's a huge need. We talked a lot about the equity views and the risks and valuations. We talk less about the risks that will lie more on the debt side. Maybe, Raphael, you can talk about that. The rise of interest rates is also a risk on the debt side. Do you view it as such?
Yeah, for sure. I mean, again, coming back to the earlier point, I mean, the question is, how much, underlying assets valuation would be impacted by rising interest rates. So that would have a direct impact on LTVs and level of risk and the amount of debt you could provide against any such underlying assets. That's one. The second point is obviously, if the base rate, not even mentioning margins, but if the base rate is increasing, then obviously in the end, your financial ratios, interest cover ratios, debt service cover ratios, and debt yields for that matter, would obviously deteriorate as well. So overall, until such time we've got this, fully repriced, asset class, and even then, if interest rates remain at, let's say, base rates remain at around 2%, obviously, I mean, the level of the amount of debt banks or non-bank lenders could provide against any asset should probably be impacted. And if, those financial ratios deteriorate and if your LTVs do not improve, obviously you could expect some margin impact as well. So, to be, as you rightly mentioned, we feel typically, the impact on the equity side before we feel it on the debt side. I had a cross, border discussion with all my colleagues across Europe to understand what they were experiencing in the various jurisdictions in Europe in terms of debt. So far, what I heard is that only in Germany do we start feeling, some margin or spread increases. In France, not so much so far, but I guess we should probably expect that market to reprice. Not least because, again, I mean, if the public market does reprice, I mean, the private market will undoubtedly follow suit, I guess.
René, on the debt side?
Yeah, that's looking at the what you just called, Raphael, and I like this term, the non-banks. So we used to be bankers, now we are non-bankers. So that's very positive.
Non-traditional lenders.
Non-traditional or alternative lenders. And again, this has been commented earlier this morning. Of course, our clients, our investors, they look at the liquidity premium. And as we have all seen, the spreads on the liquid market have gone up. Our real asset market is still very much driven by banks. right? Although the share of non-banks is increasing, but the real market makers, the real price makers are the banks, and I think everybody can witness the fact that the spreads are not increasing. The terms and conditions the banks are offering, the amount of liquidity made available by the banks has not, as we speak, significantly changed. We know that it takes time. There is always a time lag between movements, especially when they are very swift on the public markets, the liquid markets. It takes time before we see the effect on the illiquid markets. And we all know that in banks, it takes time for the information and the instructions to move from the ALM managers and those who are dealing with the refinancing costs and the cost of risks of the banks. Before this gets to the people sitting in front of the clients, it takes time. So the question, I humbly don't have the answer, are we just in, is it going to happen or not? Because obviously there are other drivers for commercial banks than pure financial drivers. So for me, this is the big question mark. There are also questions which in this type of situations typically pop up, the refinancing wall, right? The famous refinancing wall that we haven't really seen when it was expected to be huge. I personally don't really believe in that. I think it's a kind of self-fulfilling prophecy in the good sense. I think the moment people anticipate a refinancing wall, they start deconstructing the wall. So, what was supposed to be, hitting a wall, it's an upward walk. I think the market is disciplined enough today, and the market has lived through a very complicated liquidity times, through the sanitary crisis. So I think this will be managed. So at the end of the day, our ability as non-bankers to continue deploy capital at interesting conditions for our clients will pretty much depend on what the banks can do. Of course, there are other, for investors, investors are not only driven by the search for yield, there are also other considerations which remain intact, which are among the merits of investing in real assets. The ability to resilience, sorry, I was looking for the word, decorrelation, and the ability to generate extra financial benefits. I think many investors understand today that it's easier to generate impact, be it on climate or on social aspects, when investing on the unlisted market versus the listed market.
Thank you. Just before we switch to the digital topic, Marion, a quick comment on the liquidity available, maybe? Do you feel that there is less liquidity today?
No, I think that there are plenty of people who have still a lot of liquidity. So the thing is not to, people will have to be prudent in how they spend this liquidity in order not to foster continued high valuations in a moment where the market should adjust. There will still be, I think, attractivity of quality assets for the reasons we mentioned before. That's basically
if I may, because we talk about quality assets, we believe that we have some optimism because we believe the premium for green assets is not factored in exactly the way it should be. I still see in our investment committees very conservative exit multiples when it's about green investments. But on the contrary, for me, the biggest threat for those real assets will be when the price of carbon will be really factored in, especially for real estate. We have big discussions at Banque des Territoires whether we should continue to make some real estate investment, because you can take them by any direction, they still emit carbon. And So far, that price of carbon is not factored in. If in 5-10 years from now it is, then there will be a sort of wall or shock, and I agree with you. We have to be able to deconstruct that future wall, and so for me, it's not the question of liquidity or refinancing or even inflation. I think the biggest threat is, which is at the same time an opportunity, because we want to tackle the carbon issue, is when price of carbon will be factored in.
Maybe, Benedict, sorry,
Yeah.
conscious of time, but just one last comment. I mean, we were making comparisons or references, you know, to the previous GFC, etc. I mean, one must not lose from sight that, I mean, we are in a completely different world in terms of leverage. I mean, banks and all lenders have remained much more disciplined, you know, over the past 10 years than they were before the GFC. Typical leverage on real estate never really exceeded, you know, 60 to 65%, and in most instances much lower than that. Also, if you go back to the pre-GFC levels, real estate yields were lower than risk-free rates. We are not in this situation at all. So overall, I expect there will be some impact on and repricing on the private debt side of things, but clearly not to the same magnitude, and the impact, as René said, of the potential debt wall is much more limited than it was, you know, 15 years ago.
Interesting. Thank you. So I think we've talked quite extensively about these topics. I want to keep a few minutes to talk about the digital transition. And Patrick is heading our tech hub, and in particular, one of the topics that you have in mind is how to promote the digital advance rate, I would say, of the clients in the real estate space in particular. Do you want to talk further about that?
Yes, indeed. So obviously what we've seen in the last, maybe 10 years are on the corporate side, more and more interest in accelerating what's called digital transformation. And with the COVID, what has been interesting to see that it has now been called, the digital transition. So it's not so much one transformation amongst many others, but in fact a one-way street that needs to be taken by most companies to really transform the way of working and adopting some either technologies or ways of working or ways of organizing that have been inspired from the startups, which have been around in the last 20 years. So what we see more and more now are ways to measure this maturity, a bit like what has been done in green. We have various maturity audits or index, which have been developed by Big Four or consulting firms, either BCG, McKinsey, Bain, EY, or many others, which are actually grading and somehow rating how companies are doing in progressing in their digital and tech transition. So what I think could be very interesting in the real asset space is to apply those to real assets. Obviously, we need to look at what are the dimensions which are going to be mostly impacted by that tech transition. That's about operations, either maintenance, data, throughput optimization, availability of assets, using big data, AI, advanced analytics to identify insights that can then be used by holdcos to optimize their assets. So this kind of digital or tech rating could probably develop in the near future and generate some interest, obviously, on the fund side, on the equity side, but also on the debt side, to actually complement flagging or tagging of investments in green in particular.
Yes, Marion, you've worked a lot on this type of digital tools. What is your reaction to this?
Yes, I think that it's, at Ardian, I think that we have been pioneering to a certain extent in that space, because it's really one very strong conviction that we have, that in order to keep your assets relevant over the long term, you need to make sure that they are efficient. And this is also a way to ensure their affordability, because the more they are efficient, the less costly they are. So in our view, digitalization is necessary in order to optimize efficiency and cost of the assets, but as well as a factor of re-rating of the assets when you exit, right? For example, we have a proprietary tool which is called Air Carbon and Car Carbon, and by which we measure real-time the carbon emissions of our airports. And we have a number of initiatives like that. And thanks to that, I mean, industries which are, I mean, not best in class from the environmental point of view, they can become better, because you can you can ask the airlines to reduce the emissions. You can ask also the airport to be better in terms of how it uses energy. And so at the end of the day, for our investors, it's also a way to make sure that the value of the companies remain over the long term. The other project I'm responsible for is a project which is implementing the same tool to all our renewable assets. And so we have rolled out the same tools on a portfolio of 2.5 gigawatts. And this tool is, collects the data that we have, and so it's wind speed, analyzer of power curves, and all, I mean, plenty of data that we can get from the renewable assets. We analyze them at centralized level, and we have a view on each of the turbine manufacturers, for example, who is more transparent, who is who is more efficient. And the idea is to improve production, to also improve the forecast of production, because intermittency, as you know, is the biggest problem in renewables today, and to make sure that operations are better. So, for example, we analyzed power curves on all our portfolio, which is, the transformation of wind speed into power. And we realized that some operators were stopping the blades from operating at certain wind speeds, while they were supposed to stop them at higher wind speeds. So, which means that they are trading production, which is negative for us as owner, against longer lifetime, which is positive for them as operator, because they guarantee the lifetime of the plant. So these kind of things, we can do them at relatively low cost, but we improve efficiency. The other part, and that's interesting for lenders, I guess, is that we are building more quantitative tools, and that's probably less usual in corporate finance, but we are building revenues at risk, i.e., what is the confidence interval that you can have with a given portfolio of renewables. So the volatility, it assesses the volatility of our portfolios. And in a market which is becoming more and more merchant and less subsidized, our objective is to have a natural diversification of the portfolio, which enables us to to take products which are hedging products, which would be baseload products instead of pay-as-produced products, and to show also to lenders that thanks to a certain portfolio composition, we are in a position to have stable flows of revenues, and so merchant financing of renewable assets is possible, which today is not the rule in the market. So these kind of tools, they also enable us to build knowledge, quantitative knowledge on the portfolio, and in order to still be pioneering in the market, in order to open new opportunities, and notably to lenders.
Yeah, that's what I retain from what you say. For one, it improves your EBITDA, and that's probably one of the KPIs that we thought of, with Patrick. We are thinking about implementing some KPI-linked loans for real estate portfolio companies. I think the market is not ready yet, but at some point it could make sense, because digital will be a way of assessing the quality of our clients. So obviously operational improvements or EBITDA improvements is one key consequence of that, but the other one is door opener. So that's why qualitative KPIs are also very interesting. Any reactions from René, Raphaël, or Antoine on that?
Yeah.
René.
Yeah, a few comments. I think it's interesting to see how the story between digital and infrastructure has evolved over the years. I think many years ago, I think the infrastructure world was really ignoring infrastructure as a sector. At best, it was, you know, the computer equipment and the phone lines with the administrative buildings of an infrastructure operator. Then we found out, and the sanitary crisis was really an important moment for that digital infrastructure is one of the main, you know, infrastructure. It's essential needs. I think we all understood that it's an essential need. And I think now everybody realized that, no, it's not a sector on its own. Digital is everywhere in the infrastructure asset class, and this is now quite fundamental aspect of an infrastructure project. It's a fundamental aspect of your due diligence, and this is challenging the old school of looking at things in infrastructure where you're mainly looking at the real and physical assets, the contracts, and maybe the cash flows. Now people understand the importance of computing data, managing data, and using it to monitor your OPEX and to optimize your revenues. So no, I think what you're working on is very interesting, because this is, you know, becoming a key element of you know, any due diligence that people will be doing on infrastructure assets.
If I may, same when I joined CDC, I was quite impressed because the team that was CDC Infrastructure, really specialized in infrastructure assets, they started to develop a competence into investing into corporate ventures, so innovation companies that they could plug on the infrastructure portfolio to achieve the result that you very perfectly described, which is optimization and also to anticipate the trends. So for instance, for mobility, if you own a railway system, if you own airports, you have to understand which innovation will come, be it to make the infrastructure more greener, or to optimize your EBITDA. Having said that, and also another way to testify about this, I don't know if some of you went to Vivatech last week or 2 weeks ago. When you were going in, many companies that were operating infrastructure at their slot there. And one thing I wanted to also give to this panel is I wonder also if a new asset class that will be virtual assets will emerge. Because there is a class that is digital. When you do VC, of course, you're investing into digital companies. But with Meta and with what is going on in the US and probably coming very fast to Europe, there's another class that is going to emerge, which is virtual assets. That will probably have some resemblance with real assets in the way it should be managed, though it's a virtual asset contrary to a real asset. And so that's also one thing we try to anticipate, not the old Caisse des Dépôts, but the new Caisse des Dépôts, and that we all, I think, should also anticipate as potential breakthrough for our asset class.
Thank you very much. I think we are close to the... We have 2 minutes left. Is there any question in the room? Yes?
Merci. Bonjour. There was a point this morning that in some renewable transaction, the pricing is inside the sovereign, which doesn't make sense for institutional investors. So do you think in the new market conditions, then there will be enough bank liquidity to continue this trend, or that there will be a repricing? That's question number one. And question number two is, if there is a repricing, what is going to happen on equity valuation?
for you, Benedict. The first part.
No, indeed, this is a very good question. I'm glad you asked it. I don't have the answer yet, but we all have this in mind. And from what we can see on Natixis side is that it depends, in fact, on asset classes and on the structure of the asset. There are assets where there is less bank liquidity, like digital infrastructure, to be honest, is very much banked by NBFIs. There are banks, but there are less than in renewables, where historically the banks have built large teams dedicated to renewables, and they are able to lend on renewables transactions at a lower price than sovereign, yes. But I don't know if you have any other type of answer.
No, and as to the valuations, I think that as long as there will be PPA markets, there will be financing markets in renewables, and the PPA market is going just to continue developing, right? So the valuation of renewable assets could, for those which are merchant, it may be extremely volatile in the coming months or years, because yes, electricity prices are very high, but the regulatory risk is even higher. So it means that on this, probably the cost of equity will adjust upwards. On the subsidized assets in geographies where there are still subsidized assets, or those which have strong PPAs, I think that the valuation of renewables can only increase, also on the back of the fact that the CO2 is not really fully factored to the price of a dirty asset is not fully factored today.
Great.
Thank you very much. I think it's time. Thanks a lot to our panelists. It was a very interesting discussion. And yeah, let's enjoy the lunch for those who are there.
Thank you.
Thank you.